Greetings, everyone. Hello and very warm welcome to today's webinar on crisis resolution and e-money providers. My name is Robin Newnham. I'm Head of Policy Analysis in the Alliance for Financial Inclusion, and it's my pleasure to introduce and facilitate today's discussion. We're really delighted to see very good participation from across the network for this webinar. I believe all continents are represented, and a special thanks to those of you for whom it's a very early start or indeed very, very late in the day. So thanks for accommodating those challenges. Before I go further, please allow me to acknowledge the presence of AFI Deputy Executive Director, Mr. Norbert Mumba, distinguished representatives of AFI member institutions, as well as our technical partners from the deposit insurance agencies, and also our guests from the International Association of Deposit Insurers and the Bill and Melinda Gates Foundation. Thank you all for making the time to join us. You're really welcome today. By way of the agenda for today's meeting, we shall shortly commence with official opening remarks, and we'll then have some quick polling to take a temperature check of the audience's views on today's topic of discussion. Following that, we shall have the main substance of the webinar in the form of a presentation from our guest speaker, Dr. Jonathan Greenacre. And finally, that will be followed by an audience Q&A session before concluding with a wrap-up and next steps.
Good morning, ladies and gentlemen. Thank you for taking time to participate in Alliance for Financial Inclusion webinar on crisis resolution and e-money providers. From time to time, society is confronted with crisis and therefore an inevitable part of human existence. Society, however, thrives on enduring and predictable patterns defined by norms, conventions, rules, and regulations. Clearly, crisis undermines and disrupts the social pattern. It is for this reason that crisis resolution is critical to society. The COVID-19 pandemic is a classical case in point. Over the past decade, electronic money adoption has recorded phenomenal increase and has become the driving force behind the growing financial inclusion in many countries, as reported in the 2017 Global Findex report. The trend has continued since then, with mobile account estimation at 1 billion at the end of 2019 and daily transactions of 2 billion. Ghana's financial inclusion performance mirrors the global trend and shows significant contribution of mobile money to financial access. In 2011, Ghana's financial inclusion was paltry 29%. However, the growing mobile money adoption in ensuing years drove financial inclusion to 58% in 2017. According to the Global Findex report. Total mobile money account as at May 2020 was 33.2 million, which is higher than the total population. The importance of mobile money to the Ghanaian society became apparent when the government of Ghana announced restriction on movement of persons as part of measures to curb the spread of COVID-19. Bank of Ghana, in collaboration with stakeholders, published policies to promote use of mobile money as alternative to cash in order to facilitate adherence to social distancing norms and assist in curbing the spread of the virus. Preliminary data on mobile money activities within the period indicates growing activation of inactive mobile money accounts, new mobile money account registration, increased mobile money account balances, and growing merchant point of sale payments with mobile money. If the preliminary evidence is anything to go by, it can be argued that the COVID-19 pandemic and the social restriction measures have inured to the benefits of electronic money. While this crisis may be driving people towards electronic money, we should be complacent of events. We should not be complacent of events that can undermine consumer confidence in electronic money and derail progress of AFI Network financial inclusion agenda. Many people who were excluded from the formal financial sector are now accessing payments, savings, investments, credits, and insurance products through electronic money platforms. It is therefore important that workable policies are implemented to provide protection to customer assets in electronic money. In recent years, AFI has done has done a lot to encourage standard setters, regulators, and policymakers to bring electronic money under this deposit protection. The establishment of AFI Deposit Protection Subgroup of the Global Standards Proportionality Working Group is ample evidence of AFI's commitment to the deposit protection agenda for electronic money. In line with the commitments, AFI, through the Global Standards Proportionality Working Group, is collaborating with the International Association of Deposit Insurers on an issues paper on deposit protection. A total of 14 deposit insurers in various countries have been surveyed for policies and practices in providing deposit protection for electronic money. The paper, which is nearing completion, will provoke discussion on deposit protection for electronic money and expected to encourage further study. In Ghana, the Payment Systems and Services Act 2019, Act 987, explicitly states that electronic money is protected in line with deposit protection rules. However, we recognize that effective protection of electronic money deposits requires a combination of measures. For this reason, a risk-based and proportionate licensing regime has been implemented for electronic money issuers. This includes integrity capital regime, fraud management, cybersecurity systems, and AML CFT regime, among others. In addition, banks holding electronic money float account balances on behalf of electronic money issuers have to adhere to the prudential limits of 25% of net worth or 40% of multiple electronic money issuers. While these measures may appear adequate and effective on paper, it is important that we subject them to a careful analysis in order to unearth possible weaknesses. By this approach, we will be able to retool the safety net tools and make them effective. It is against this background that Jonathan Greenker of Fletcher School of Law 2-year multi-country study on deposit protection for electronic money is very important piece of work in the financial inclusion efforts. This webinar provides opportunity for us to learn from analysis of deposit protection measures in a sample of countries, make contributions, and draw lessons for evidence-based policies. I encourage everyone to actively participate in this webinar and help shape AFI's network agenda for financial inclusion. Thank you very much, and I wish you all a fruitful discussion. So thank you.
Thank you so much, colleagues from Bank of Ghana, for your opening remarks, which I think have set the scene for today's discussion extremely well. As was highlighted in those remarks, the COVID-19 pandemic It's really showing us not only how essential it is to have an efficient and secure digital payment system in terms of crisis, but also that it pays to scenario plan, and in particular to prepare often for the worst case scenarios, however unlikely they may seem at the time. And so today's topic really seems to be perhaps even more pressing and urgent in light of what we are experiencing today with the crisis. Before we go further and introduce Jonathan, we'd now like to take a quick temperature check of views here in this virtual room on the topic. And so we have three polling questions. So I'd like to ask please if the polling questions could be displayed. Okay, so the questions should be coming up on your screen now. I'll read them out just in case anyone cannot see them. So the first question, to your knowledge, has your country conducted a regulatory diagnostic for the collapse of a mobile money provider? Yes, no, or don't know. The second question, how concerned are you that customers could lose funds from the collapse of a mobile money provider in your country? Very concerned, somewhat concerned, or not concerned at all. And then the final question, how aware are you of tools that can be used to protect user funds in the event of collapse of a mobile money provider? So we'll just give you a minute or so to answer those three questions, and then we'll pull the results up. Okay, so I think most of you have had the opportunity to vote, perhaps one or two still coming in, but we can see quite clearly a heavy majority have not yet conducted a regulatory diagnostic for collapse of a mobile money provider. And I think that's probably what we would expect. The second question, most of you are extremely concerned that customers could lose funds from the collapse of a provider. And again, that's not surprising given that we know that mobile money providers are often, mobile money customers, I should say, are often very new to financial services and are therefore amongst the most vulnerable users. And then finally, on awareness of tools, it's a bit of a mixed bag. 38% say they're very aware, 30% somewhat aware, and then the rest not aware, but still quite a number of participants that I think will benefit by the content that Jonathan is going to share over the next 20 minutes or half an hour. So very interesting results there. I think we can close the poll. And I'd now like to move on and introduce our main speaker today, who's Jonathan Greenacre. Jonathan is both an academic and a lawyer. He has a distinguished research record focusing on the intersect of regulation and digital technology. He holds a master's in law and finance and a PhD in law from the University of Oxford. And he's also worked in an advisory capacity with multiple international organizations, including the UN, the IMF, and the World Bank. And today he'll be sharing insights from a 2-year project on regulation for the protection of mobile money customers' funds, on which he was the lead researcher at the Fletcher School, as well as insights from his wider work over the last 10 years or so. So with that, I'd like to invite Jonathan, please, to commence your presentation. Thank you.
Thank you very much, Robin, and good morning, good day, good evening, wherever you are. It's great to be connected to you all and to get the chance to talk about protecting customers' funds in mobile money systems. I was really interested to see those poll results. I actually wish we could do that poll at the end of my presentation and see whether you're more concerned or less after you hear what I have to say. I'd be very interested to hear your views. Okay, so if we could go to the next slide, please, Kath. So what I'm going to do today is talk about protection of customers' funds, both in terms of the need, which I think we're probably pretty clear on, and I think Clarence's very interesting speech notes ties in with what I'm going to talk about. But I'm going to focus primarily on a framework for analysing tools we can use to protect customers' funds based on a functional approach. And then I'll talk about findings that I've come across after 8 or 9 years of using a functional approach and studying mobile money regulatory regimes across 16 countries. And then I'm going to propose some next steps about how we might address some of these regulatory gaps. And I think you may find this framework, the functional approach, as a useful diagnostic to start thinking about regulatory protections in your jurisdiction for customers' funds and for the surrounding economy. Okay, next slide, please. So what I'll do is start out talking about the need for looking into the protection of customers' funds. Now, based on that poll, it looks like I don't have to reel out too many lawyerly arguments to try to convince you that this is an important topic. But in case I do, the rapid growth of mobile money, in my opinion, makes protection of customers' funds extra important. And these statistics are drawn from the IMF's recent survey on this topic. Next slide, please. But I think just like Clarence's speech tells us, that the COVID crisis has actually amplified and accelerated the use of mobile money in a pretty big way. So, for example, in Rwanda, mobile money use has increased 5 times from its pre-pandemic norms, and Nigeria has experienced a 15% increase in just 1 month. So there's increased use, and this is accelerating a trend that was already taking place. So a lot more money in a lot more countries are going through mobile money systems. Okay, next slide, please. Now, because I'm a lawyer, I'm trained to think of worst case scenario. That's what you get when you go through law school. But I think when you look at the financial history of the world and financial cycles that we normally see, there's always a crash when a new financial service grows, particularly when it grows really quickly, and particularly when regulators aren't very clear on what's going on. So, for example, the crash in the US that triggered the global financial crisis, the bankruptcy of Lehman Brothers, the collapse of other investment banks, there was rapid growth in what was called shadow banking in the lead up to that crash. And looking back, we see that a lot of regulators really didn't understand what was going on. That we've seen the collapse of microcredit sectors in some countries, particularly regions of India, Morocco, Pakistan. And so there's a pattern here. And somewhere along the line, a mobile money firm will go bankrupt or at least face really severe liquidity problems. That's just how the history of finance goes. And we've seen little wobbles of that so far. So, for example, in 2016, the Ugandan government shut down mobile money just before the election that took place that year, and a lot of things went wrong. People couldn't pay for utilities, people couldn't pay for school fees. There was a major damage to financial inclusion goals because a lot of people, at least temporarily, reverted back to cash. But on the right-hand side, I have a picture from a newspaper article about a short-term outage of Safaricom's M-Pesa service in Kenya. And that was only for 2 hours. And people couldn't pay for electricity, water, petrol. Now, the system was brought back up to speed. But given that in 2018, between April and June, M-Pesa processed 418 million transactions. Imagine what would happen if this delay, this short-term delay, a 2-hour delay becomes a 2-day delay or a 2-month delay, or what might actually happen be a 2-year delay where a mobile money provider just stops its services. And I'm going to explain how that might happen. Next slide, please. So I had the pleasure of talking with some of you at the AFI-GPF in Rwanda last year, and I put up this slide, and I just want to go back to it very briefly, because what I'll talk about today is bankruptcy of mobile money firms. And the table on the right shows you the average length of a corporate bankruptcy procedure in the 4 countries listed there. So this is taken from the World Bank, and the figure here is for an average mid-sized hotel chain. So if a mid-sized hotel chain in Bangladesh goes bankrupt, bankruptcy proceedings will take, on average, 4 years. So that means if customers have got money stuck inside one of those entities, they may have to wait 4 years before they can get their money back out. In Kenya, the figure is 4.5 years. That's for a mid-sized hotel chain. So just imagine if Safaricom goes bankrupt tomorrow, 4 or 5 years might be optimistic. And if we go to the next slide, what we might see then is things could get messy. You could get lots of people who can't get access to their money, can't pay school fees, can't pay utilities. And so we may have a major problem. So what I've been doing over the last 8 years is looking into this and looking into regulatory arrangements. And I'm going to talk to you about regulatory arrangements that seem to exist across countries and what we can do about it. Okay, next slide. Yeah, so like I said there, what happens if there's a bankruptcy if COVID hasn't gone away, or if there's an outbreak of it again in an even more severe form, things could get really messy. Okay, next slide, please, Kat. So what I'm going to do now is talk about some studies I've been doing on this topic over the last few years, and particularly developing this functional approach. And I think you're going to find it a useful diagnostic for trying to unpack some of the regulatory confusion about mobile money. And I'll just give you a brief background here about why I find this interesting. Well, firstly, I think it's important, and I think we need to make strong, stable mobile money systems. But secondly, it seems to me that there's still a great deal of confusion about mobile money. I hear a lot of labels about what mobile money is: mobile payments, mobile banking, branchless banking, e-money, digital payments. And I think there's enormous confusion about what it actually is, which means there seems to be a lot of confusion about the risks and how to regulate it. So what my work does is to say, okay, do we actually understand the risks, really, if we're really honest with ourselves? And what tools do we have to address them? And then I think a useful question for every country is to say, do I have those tools in my jurisdiction? So I've worked on this. I've worked with the central banks of Malawi, Samoa, Fiji, Tonga, Vanuatu, Papua New Guinea, Kenya, Ethiopia, Tanzania, Uganda, Nigeria, Pakistan, India, Indonesia, and Bangladesh. The last 9 of those countries through a project at the Fletcher School of Law and Diplomacy at Tufts University, generously supported by the Gates Foundation. And I found that the functional approach appears to be a useful diagnostic, but also we appear to have regulatory gaps. So I'm not going to talk about any specific jurisdiction. I'm just going to talk about general findings. Okay, next slide, please. So let's start with the functional approach. So what the functional approach aims to do is to say, let's try to understand the whole system, the risk to customers' funds, how those risks interrelate with each other, all the different tools we can use, and how those tools interrelate with each other. Because some tools can actually impede the operation of other tools. So they can actually make other tools operate worse. So we need to understand how the regulatory tools fit together. So the general idea of it is, let's try to forget what we think we know about mobile money. Let's ignore the name we give to it: fintech, digital payments, mobile banking. And let's ignore the name of the firm providing it. Fintech 21 company, Safaricom, Vodacom. Just focus on what the service actually does, its functions. So what we'll talk about are the functions it performs, the risks to customers' funds that are associated with those functions, tools that can respond to those risks, and then we analyze the effectiveness and trade-offs involved in those tools. So for example, you can see role for mobile money. It's interesting that there was discussion earlier about deposit insurance. Normally, mobile money doesn't have access to deposit insurance, which actually means it's got a very different role in the economy to the banking sector. If we extend deposit insurance to mobile money, it takes a role that is more similar to bank deposits, which has got benefits and costs. So it's trying to unpack a lot of the assumptions that we have about regulatory tools. So sometimes when I talk about these things, it makes me quite unpopular with the people I'm talking to, because I ask questions about the desirability of certain tools. But I think at least thinking them through can help us get a little bit clearer about what we're looking at. Okay, next slide, please. So let's start with functions. And again, let's forget what we think we know about mobile money. So when I try to bring my legal training to bear on a problem, if I want to understand the functions, I read the contracts. So this is the M-Pesa contract between Safaricom and customers. And if you study it, then you see that an M-Pesa account, let's just call it a mobile money account, provides deposit-like services because it provides the same basic services that you get from a bank deposit. You can deposit money, you can transfer it, you can store it, and you can withdraw it again. Now, they're the basic services you get through a bank deposit. But these services are limited in ways that they're not normally limited in bank deposits. So, for example, traditionally, in mobile money, you couldn't get interest payments. So you can see clause 3.9, no interest will be paid on your mobile money account. Traditionally, a lot of mobile money systems were not interoperable, and often there were limits on how much you could store in a mobile money account. Now, these limitations are breaking down due to regulatory changes, but at least originally, mobile money functioned as a limited purpose deposit. It provided the basic services of a bank deposit, customer-facing basic services of a bank deposit with some limitations. So a limited purpose deposit. Okay, next slide, please. So step one, we've worked out the functions. So you can see on the left-hand side of this diagram, here are the functions. So a customer, and if you follow the arrows, hands over money to a mobile money firm. Now, the beauty of the functional approach is it doesn't matter what that firm is called. It doesn't matter if it's called Fintech Firm 2021 or Safaricom or any other type of firm. If it provides those services, then it creates the same risks. So it provides money to the firm provides e-money back to the customer, and the customer can do all those things with e-money: deposit, transfer, store, and withdraw. Now, I want to talk about risks. Now, a lot of people say they know what these risks are, and then if I say, okay, can you tell me what they are, they often get muddled up. So one of the risks we have is liquidity risk. So what that means is the mobile money firm takes customers' funds and puts them in what's called an illiquid asset. So basically an asset that you can't turn into cash very easily. So for example, the mobile money firm takes the money and builds a new phone tower using customers' funds. So then the customers say, I want to withdraw my funds, and the mobile money firm says, sorry, I can't, because all the money's locked up in a mobile phone tower and I can't sell that very easily. What I think is more complicated is bankruptcy. So the mobile money firm goes bankrupt, and as all of the regulators in the audience know, firms go bankrupt all the time, unfortunately. So a firm goes bankrupt, and what happens is it enters into bankruptcy proceedings, and usually bankruptcy proceedings have two rules, and those rules create the risks I've listed below. So one of them is loss of value risk. So what that means is customers are considered usually unsecured creditors of a mobile money firm, and don't worry about what that means for now. And so what that means is they are repaid last in bankruptcy proceedings. So the firm owes debts to other people and other companies, and it pays out all those debts. And if there's anything left, then customers will get it. So you can see the little green figure there. It's to mark that a lot of customers' funds, like the value of the money they originally gave over, might disappear into the night because some of it's used to repay debts to third-party creditors, the figure in red. So the customer provides $100 to the mobile money firm, but $70 of that goes to third-party creditors during bankruptcy proceedings, and so the customer only gets $30 left. The last risk is illiquidity. So what this means is usually in bankruptcy proceedings, you can't get money out of a bankrupt firm until bankruptcy proceedings conclude. So there's a delay. So you remember the table I showed you originally. If you've got to wait 4.5 years to get your money out of a bankrupt firm in Kenya, and that firm is your mobile money provider, you're going to get pretty angry and potentially pretty desperate because your money is stuck in the system. Potentially worse than that is payments in the economy will just stop for potentially 4.5 years while bankruptcy proceedings take place. And in my opinion, that's a major, major problem, particularly in countries with very well-established mobile money systems. Next slide, please. So what I look at is like I said, in our project, and remember we're up to the third stage now of the functional approach, what tools do we have to address these risks? And this is where things get interesting, because a lot of countries say, well, we don't let mobile money firms store money in a mobile phone tower. They have to store the money in a bank account. So isn't that great? And I say, well, what's the quality of your bank regulation? A bank's actually well protected. Do you have deposit insurance for banks? Do banks collapse regularly? Do you have accelerated bankruptcy regimes for banks? And actually, if we dig a little deeper, storing money in banks may not actually be the best option for countries. It could be, but it actually creates its own risks as well. Loss of value risk. A lot of countries, particularly countries that follow the English legal tradition, common law countries, they say it's okay, money is stored in a trust. So that's actually a photo of William Shakespeare's last will and trust. And everyone says that protects customers' funds. And I say, okay, well, how is the trust set up? How is it monitored? Do you have independent trustees? How do you make sure the trustees are actually storing the money? And a lot of regulators don't like it when I ask those questions. But if I don't ask them and the system collapses, the trust could be completely useless and there's no protection to loss of value. When I ask about illiquidity, I say to countries, do you have any accelerated bankruptcy regimes? So let's just say bankruptcies take 3 years in your country. Do you have anything to accelerate that process for mobile money systems? Usually I get question marks coming back at me through cyberspace. So, and that's partly because we don't really know what sort of accelerated bankruptcy regimes we need for mobile money. Next slide, please. So where I think this gets particularly worrying is I then say to a lot of countries, okay, you're not sure of the tools you have. Do you have any emergency powers such that if you're faced with a disaster like the Lehman Brothers collapse in 2008, or some of the microcredit collapses that we've seen, or a mobile money collapse, particularly at the moment when COVID is making mobile money extra important, do you have any sort of accelerated bankruptcy regime, any emergency power? And usually I get the same question marks with that little figure on the right-hand side. So I think we have potential problems that we need to address. Next slide, please. Okay, so now I'm going to talk a little bit more about the regulatory gaps that I see. I hope that the diagram in the previous set of slides gave you an overview of how a mobile money system works and the risks. Now I'm going to use a table, and I think this is the type of diagnostic that you may find useful. Next slide, please. Okay, so yeah, sorry, thank you. Thank you. So we'll start out. So Remember, we've identified functions. Now we look at risks, then tools, then general findings. And that general findings means analyzing the tools. So let's start with liquidity risk. So remember, this is the risk that the mobile money firm stores customers' funds in an illiquid asset, like a mobile phone tower. Next slide, please. Now, what I notice when I talk to countries is they say, we have tools and everything's fine. Look at these tools we've got set up. Next slide. And then I dig a little deeper. And in my opinion, it's not quite as pretty. So, like I said, I look at the bank regulatory regimes and I say, hold on, but the banks aren't well regulated. Not that I say this, but I think the banks aren't well regulated. You have no deposit insurance. You might actually be better served storing funds in the central bank or in government bonds, or at least thinking about it. And some countries say we already do that. We require mobile money firms to store funds across asset classes. And I say, well, what are those requirements really? You say you have them on in your regulatory frameworks, but do you actually enforce them? How do you make sure that the funds are actually diversified in the way that they're meant to be diversified? And how do they reconcile with e-float? It's actually operationally quite a hard thing to do. Pass-through deposit insurance, people say, well, isn't that great? And I say, well, but how about if you've stored funds in other assets like government bonds? A lot of countries haven't implemented pass-through deposit insurance. And crisis management tools may be available, but it's often not clear whether countries have crisis management plans like lender of last resort to say, okay, the mobile money firm has got a major liquidity problem. We're going to provide some emergency liquidity directly to it. Next slide, please. Okay, let's go to bankruptcy, loss of funds. So remember, this is where some of customers' funds are used to repay debts that the mobile money firm owes to third parties, other creditors. Next slide, please. So common law countries, so these countries follow the English legal tradition, say Kenya, Uganda, Tanzania, Fiji. They'll say money stored in a trust. Civil law countries often don't appear to have any protection against loss of funds because trust instruments generally don't exist in civil law countries. So to me, that's a major problem. And then crisis management plans. Next slide, please. And when I dig a little deeper, I find actually a lot of countries say they use trust, but actually don't. They might actually store funds in an escrow account, but which actually provides less protection than a trust. Often there's legal problems with these trusts, or they're not governed very well, or there are supervisory problems. And what this means is the trust may not be effective in law, in which case the firm goes bankrupt and customers' funds do actually disappear into the night, going to third parties. Many civil law countries try to use substitutes for trusts, but they don't often operate very well and they face the same problem as trusts. Okay, next slide. The last is illiquidity. So this is a delay, remember? Customers' funds are stuck in the system and there's a delay in getting them out while bankruptcy proceedings take place. Next slide, please. Some countries seem to have a sort of funds dispersal mechanism where the government or the central bank can descend on the bankrupt firm and take money out, the customers' funds, and disperse them to customers. But again, I dig a little deeply, and next slide, please. I find that it's not very clear how these operate, the legality of them, how they interact with bankruptcy law, and they might actually defeat financial inclusion goals because a lot of these systems involve returning funds to people in cash form, which, as we know, is the opposite of what financial inclusion aims to do. And these crisis management plans don't appear readily available. So, for example, there's no emergency powers where the government can sweep in and fix up a bankrupt mobile money firm over the course of a couple of days, which is what we can do with banks in some countries. Next slide, please. And lastly, what concerns, back please, just one. Thank you. Yeah. And just on the right-hand side, that box there seems a lot of confusion about how these tools fit together. So for example, a lot of countries say, I store money in a bank so it's protected against loss of value, loss of funds. And I say storing money in a bank does absolutely nothing to protect against loss of funds. Or countries will say, I store money in a trust, so it's protected from liquidity problems. And I say storing money in a trust has absolutely no impact on liquidity risk. So there are other tools I could talk about. There are a lot more policy implications I can talk about, but unfortunately we don't have time. But in terms of thinking about this in terms of a diagnostic, I hope you see the intuition here. We identified functions by analysing the contractual terms. We then look at risks, which you can see in the column on the left. Then we look at all the tools we can use. And there are many other tools that I've seen that we can talk about that we just don't have time. And then we analyse the desirability of the tools, whether they work well, policy trade-offs, and that's how we can make some progress here in designing some stronger regulatory regimes. Okay, next slide, please. So I think the reason for regulatory confusion is we haven't designed certain next generation regulatory tools that we need. So for example, liquidity risk, if a mobile money firm faces a liquidity problem, maybe we need some sort of emergency government powers like lender of last resort or bailouts. You might remember I was talking about trusts and trust-like instruments. We don't really know what those governance rules should look like because mobile money is so new compared to other financial services like banking. And we haven't yet designed an accelerated bankruptcy regime that we can use to address illiquidity risk. So I'm certainly not pointing the fingers at regulators and saying that they should do better. Not that at all. We're dealing with a financial service that is still very, very new compared to the overwhelming majority of financial services that exist in the world today, like banking or insurance. So we're all learning here. I just think that we need to accelerate that process because we've now got mobile money systems that are big enough that if they collapse, we have major problems. Next slide, please. So like I said, I think we need to address this topic now. We have rapid growth of mobile money, and I'm just putting this slide up again to come back to that point. Next slide, please. And like I said, things could get messy if we have a collapse at the moment or in the foreseeable future, because I think COVID is not going anywhere anytime soon. We're going to be dealing with the after effects for quite a while. So I think the time is right to really look at this topic. Next slide, please. Okay, so finally, and just very briefly, I'm going to propose some next steps for addressing this topic. And the reason I think now is the right time, it's not just because of my argument that I think mobile money is now extra important to a number of countries. I think we've now got enough of an understanding about a conceptual approach. We've now looked at enough countries, and I think we can pull together insights that we know to start pulling together a form of regulatory toolkit. Next slide, please. So what I'm suggesting is a regulatory toolkit that follows the broad conceptual approach that we've discussed. Holistic, looking at how the risks interact, the tools interact, based around a functional approach. Going back to first principles, what does this service do? What are the risks to customers' funds and the economy? What are all the tools we can use and what are the trade-offs? We can combine research we've got at the moment and work to be done on next generation regulatory tools. And I think maybe there's an opportunity to work together by combining that research into a user-friendly guide for regulators through some sort of collaboration with the working group. And a document like this could be presented at the AFI-GPF in 2021. And I'm being optimistic here that we're all going to be back on deck and we're going to be able to meet in person by then. Next slide. Thank you very much and looking forward to the discussion. And if you've got any questions that we can't cover today, feel free to email me on my address below.
Thanks so much, Jonathan, for the comprehensive and excellent presentation, and also for making quite a clear proposal at the end there as to how to take this forward potentially with the global Standards Proportionality Working Group. We saw in the polls at the beginning that around 70% of you were already very concerned about customers losing funds in the event of a collapse of a mobile money operator. So after Jonathan's presentation, that's probably gone up a little bit to 80%, maybe 90%. But I think reassuringly as well, Jonathan also highlighted a range of tools that can be applied and developed further to deal with this issue. So we have a little time available for questions, about 10 minutes or so before we wrap up the session. So if you would like to ask a question, just raise your hand, and then we can call on you, or otherwise you can type a question into the Q&A. Or if you would like to make a comment as well to share something from your own country's experience, that's also absolutely fine as well. I'm not seeing any questions right now, so to kick things off, I'm going to ask one myself. Jonathan, you mentioned some of the distinction there between civil law jurisdictions and common law jurisdictions. And I can see we have both represented on today's webinar. So could you just clarify a little more specifically how the tools available and also the policy choices may differ between the two types of legal regime in this circumstance? Thanks.
Thank you, Robin. Yes, I'd be happy to. So common law countries generally follow the English legal tradition, and like I said, Kenya, Tanzania, Fiji. Civil law countries generally follow continental European legal traditions. So common law countries use trusts, and without going into the legalities too much, what trusts basically do is if the trust is operated effectively and customers' funds are stored in the trust, then in bankruptcy proceedings, in theory, those funds can't be used to repay debts that the mobile money firm owes to third-party creditors. So it addresses loss of value risk or loss of funds risk, you remember me talking about. Civil law countries, it's less clear. Reason being is civil law countries generally don't have trusts, so they can't actually just store money in a trust. So what happens in a number of civil law countries, there's no, as far as I'm seeing, there's no regulation that addresses loss of value risk because there aren't trusts. So to me, that's a major problem. What those countries can use are instruments called a fiducia or related fiducia contracts. But as I mentioned, as of yet, we don't really know how they apply to mobile money. We don't quite know what their legal effect will be. And that's something I'm going to be looking at over the next couple of months and writing a paper on, which I'd be happy to share with the working group. But the long and short of it is it's not clear how civil law countries can get the same protection as common law. It needs more research.
Thanks very much, Jonathan. And I can see that we have a few questions have come in now. So I'll read the questions that have come out, and you can perhaps take a back look. So firstly, we have a question from Bernadette, which is, aside from the liquidity requirements, do other countries also have capital requirements when it comes to electronic money issuers? So specific question there. We then have a question coming from the colleagues from the Morocco Deposit Insurance Agency. Do you think that a sound supervision can help to mitigate all risk? So to what extent can supervision tools be the answer here? And then we also have a question that's come in from Jonas, and Jonas is asking, what are the tools that are currently in place in other parts of the world, and amongst those tools, do we have indications of the effectiveness essentially in helping to prevent collapse of mobile money operators? So perhaps, Jonathan, if you want to make a start with those three, and you can take them in any order that you choose.
Thanks, Robin. Yes, I'd be happy to. And these are all great questions, and I think we need a lot more research into all of them, frankly. Capital requirements is something I've seen in a lot of other countries. I think we need to query the usefulness of capital requirements, particularly whether they address the problem that arises if a firm goes bankrupt. Capital requirements can be useful, but as I mentioned in the slides earlier, the risks that arise from bankruptcy are very specific: loss of value and illiquidity. And unfortunately, capital requirements don't address those actual risks themselves specifically. So yes, while I do see other countries with capital requirements, I don't think they're the most effective way to address these risks. In addition, we need to be careful because capital requirements obviously imposes increased regulatory costs on firms, and that can impede financial inclusion goals. So I think we need to be very careful about how we use capital requirements, and I would focus more on the other tools that we've been talking about: trusts, fiduciary contracts, some sort of accelerated bankruptcy regime. Mohammed talking about sound supervision. I think, well, sound supervision can certainly help, but I think, in my view, we have a preliminary problem, which is in a lot of countries, I don't think we have the right tools in place yet. Some people might argue that the original M-PESA model worked very well, in that Safaricom went to the Central Bank of Kenya and said, here are the contractual rules that we've got with customers. What do you think? And the Central Bank of Kenya looked at them and went through them and was very careful and didn't actually develop any regulation in addition to those contractual terms. Instead, the Central Bank of Kenya just supervised those contractual terms. So that was maybe an instance where maybe we had pretty good, at least okay-ish rules from the start and really good supervision. I just think what's happened since then is that a lot of countries have felt the need to develop regulation, and I'm not sure that the regulation developed actually addresses the risks. And so, at least some of the regulation, and so supervision I don't think is going to help without really good rules. Deposit insurance, I think, and again, when I say these things, I'm probably going to be immediately unpopular amongst the group, but I think it's a much more complicated question than it might appear. I think one of the reasons mobile money spread very quickly is because firms were subject to less regulation than banks, and that was reasonable because they imposed less risk than banks. Once we start extending deposit insurance over mobile money firms, there's the risk that they might engage in moral hazard, take extra risk because they know funds are guaranteed by the state. So we may then need to regulate them more to address moral hazards, such as through capital requirements. And that might then get in the way of financial inclusion. So I think deposit insurance is something we need to unpack and look at from a bunch of different angles. And then there's an implementation problem, and I haven't seen a country that's implemented pass-through deposit insurance and is confident that it would be able to use pass-through deposit insurance effectively. So I think deposit insurance is a complicated topic that needs a lot of very careful consideration. Tools that are in place in other parts of the world, well, we could talk for probably another 3 or 4 hours on that, but I'll just give you one example because there are a lot out there. One example, one tool that's used in a number of countries is storing funds in a separate firm. So there's the mobile money provider, but the mobile money provider never gets customers' funds. They're stored in another firm. So for example, Safaricom never actually gets customers' funds. They're stored in a separate company called the M-PESA Holding Company. You might say, well, who really cares? That just sounds like corporate law jargon. But actually that's very helpful because what that means is it doesn't matter if Safaricom goes bankrupt. In theory anyway, if the rules are actually implemented properly, because the funds are actually stored in a separate firm. And all that firm does is store money and pay money. So it's easy to monitor. And if it collapses, it should be easy to get money out of that separate firm. It doesn't do mobile phone services and text messages and all that sort of stuff. It just stores and receives money. And some countries like Tanzania have regulation that require mobile money firms to use that structure. So that's a tool used elsewhere, and that's something that I think can be very useful. Jonas, on are there indication on limitations or indicators for pending collapse? Not that I've seen. And part of the reason is they say in regulation it's developed to fight the last war rather than the next war. So just like there was there wasn't enough research and studies of pending collapse in shadow banking in the US or microcredit in a lot of developing countries, I haven't seen any indicators that can help us to understand pending collapse of a mobile money firm. Robin, I'll just take the liberty of continuing, if that's okay, until you cut me off. I can see some more questions here.
Yep, please do, but I noticed we have a raised hand actually from Monsieur Ben Alima, head of the Morocco Deposit Insurance Corporation. So I'd like to take that question, if that's okay. And I believe Monsieur Ben Alima will speak in French. So if you need the English translation, just click on the interpretation and select English.
Merci beaucoup. D'abord, je voudrais vous remercier de cette initiative qui nous permet de nous voir et de communiquer par ces temps difficiles du Covid-19. Vous savez très bien qu'on ne peut pas se déplacer pour le moment et j'espère que la FI va multiplier ce type de webinaires parce qu'ils sont très, très intéressants. Alors, moi, je voudrais juste un petit peu revenir à l'expérience marocaine parce qu'il pourrait apporter un certain nombre de réponses aux problématiques qui sont posées. Aujourd'hui, au Maroc, nous avons pratiquement 21 banques et nous avons 15 établissements de paiement. Et nous avons un développement extraordinaire des solutions mobiles avec une interopérabilité entre les différents acteurs qui vient à peine d'être mise en place. Sauf que nous avons des solutions mobiles qui sont adossées à des comptes bancaires, et dans ce cas-là, elles sont garanties par le système marocain de garantie de dépôt. Et nous avons des solutions mobiles qui sont adossées à des comptes de paiement, et donc ils ne sont pas garantis. Donc nous avons un problème de distorsion de concurrence par rapport aux consommateurs. Celui qui a des comptes mobiles adossés à son compte bancaire est protégé, puisque l'argent vient de son compte bancaire, et celui qui a ouvert un compte de paiement, il voit son argent non garanti, même s'il utilise un wallet, un M-wallet comme les autres. Donc, dans le cas marocain, nous avons la réglementation à créer, non pas la fiducie, non pas un trust, mais ce que l'on appelle un compte de cantonnement. Ça veut dire que l'établissement de paiement, quand il va commencer à collecter l'argent des créateurs suite à l'ouverture de compte, il doit avoir un compte bancaire cantonné. Or, si l'on voit la réglementation actuelle, le compte bancaire lui-même, qui contient une pluralité de comptes, doit être couvert à hauteur de $8 000, ce qui est ridicule. Donc, il y a certaines personnes, notamment les gens de la Banque mondiale, qui proposent ce que l'on appelle l'approche pass-through, c'est-à-dire de garantir, y compris les personnes qui sont identifiées à l'intérieur du compte de paiement, mais qui doivent payer, d'où vient l'argent. D'où la deuxième idée de créer, à l'instar du système de garantie de dépôt bancaire, un système de garantie propre aux établissements de paiement. Mais si on fait un parallélisme entre le système de garantie pour les dépôts bancaires et un système de garantie pour les comptes de paiement, on constatera que les établissements de paiement devront cotiser dans ce système de garantie et par conséquent, ça va renchérir justement le coût des transactions parce qu'on va prélever de l'argent sur ces comptes-là pour les garantir. Il y a également une troisième approche, c'est tout simplement d'intégrer les comptes des paiements dans le système de garantie de dépôt actuel tant que leur nombre ou leur volume reste, je dirais, circonscrit ou moyen. Nous, aujourd'hui, au niveau du Maroc, nous avons émis juste un souhait. Nous avons proposé que les établissements de paiement créent leur propre système de garantie, mais non pas à travers la loi, mais à travers, je dirais, une approche consensuel, contractuel. C'est une association, c'est comme le cas de l'Allemagne par exemple, où nous avons un système de garantie de dépôt qui est une association. Ce n'est pas la loi qui l'a créée, mais tout simplement la profession va se réunir et va dire, pour donner plus de crédibilité à nos comptes de paiement, on crée un système de garantie de dépôt par contrat, quitte à l'intégrer demain dans un texte de loi s'il y a une modification de la loi. Mais tout cela, c'est juste pour répondre à une problématique, je dirais, qui devient de plus en plus cruciale. Au Maroc, d'après les informations dont je dispose, nous avons 360 000 comptes de paiement qui ont été ouverts dans un laps de temps très, très limité. Et maintenant, avec l'interopérabilité, on va voir le nombre de ces comptes de paiement s'accroître sans qu'il y ait une garantie adossée à ces comptes de paiement. Voilà ce que je voulais partager avec vous. Merci.
Thanks so much, Monsieur Benalima, for sharing the experience of Morocco. Jonathan, did you have any reaction or any comment you'd like to make on that?
None particularly, but I did find that a very interesting account of development.
Great. So I think we've got one last set of questions that we can take before we wrap up, as we're a little over time. So there's 3 questions are pulled together. We have one from Kabaz, who is asking, will it help to spread risk if the mobile money deposits are across multiple banks instead of a trust fund in just one bank, for example? Then we have a question from Dennis. Do you know of actual collapse of any money provider and corresponding actions taken by authorities? So are there any case studies here, or we're just talking hypotheticals at this stage? Okay, now there's two more questions. So we have an anonymous question asking, do you think regulators should set or require specific financial ratios, such as liquidity ratios, to be met by mobile money providers? And then finally, we have a question from Arif, who is asking, specifically related to Safaricom, why do you believe that this model helps to safeguard consumers' assets? In case of bankruptcy of Safaricom, its creditors can they legally dissolve M-Pesa's holding in order to satisfy their own claims? So a specific question there on M-Pesa. So any of those 4 that you'd like to comment on, and in any order that you'd like, please, Jonathan. Thanks.
Sure. So you'd like me to get through all 4 or choose one?
If you can answer all 4, please feel free. If you just want to limit yourself to 2 or 3 and then maybe think about the other ones and get back to us later, that's also fine.
Yeah, sure. Okay. Well, Kabaz, I think that's a very reasonable question, and that's, I think, our default. That, okay, well, maybe it's not useful to store money in banks, so we can store them across multiple banks and everything's okay. It does spread risk, but I think a problem is a lot of regulators stop there. And I say, well, what happens if there's a collapse to the banking system, or there's a shock to the banking system? It can be correlated across banks and you still have the same problem. What happens if, say, if money's stored across 5 banks and one bank goes bankrupt? Well, how do you determine which mobile money customers lose which amounts? So how do you supervise that to make sure e-float issued to the public matches funds spread across those 5 banks? That's actually operationally a lot more complicated than it might appear. So I think it can help, but with all of these tools, and I hope the intuition is clear, that we need to go beyond just saying money's stored in a bank or I've got a trust, because a lot of these tools don't work by themselves without careful drafting, and they can actually create their own risks that need to be addressed. Dennis, I don't know of collapse of a mobile money firm. There's been theft. So, for example, MTN Uganda in 2012, there was theft of some customers' funds. So I don't know of actual collapse. But I certainly don't want to be a regulator in charge of the first mobile money collapse, because that means I'll have no one to turn to copy. So no, I don't. Liquidity requirements. What's very common across jurisdictions is a one-to-one liquidity requirement. So you must store. So you must have you must have liquid assets. So, for example, bank deposits or government bonds that are equal to the amount of e-money you issue to the public. So that's a one-to-one relationship. That's the most common liquidity ratio that I see. Arif, that's spoken like a true lawyer, and I wonder if you've got legal training, because yes, that's something that needs to be looked at. And this is what again, the intuition I'm trying to explain, that even when we say, great, funds are stored in a separate firm, let's rest easy, the story doesn't end there, because creditors can do exactly what you've just said. So even when we have these tools on the books, even the basics of the tools, we need to ask the sort of questions that you're asking. How can we make sure that in practice, the M-Pesa holding company is legally separate from Safaricom? Because you're right, it's not clear and it needs to be studied closely. Mohammed, your last question, and I think this is, I think I might have answered 5 rather than 4, but this is just a great one to end on, which is we need to study exactly the sort of resolution regime you're talking about. Set up some sort of system so that if a mobile money firm goes bankrupt, the government can transfer customers' funds to a solvent mobile money firm. I think a lot of regulators believe they have the power to do that, and they believe they have the administrative ability to do that. But then if you look at their regulatory frameworks and ask questions of supervisors, it's not as clear that those powers exist. So I think we need to research exactly the sort of question you're talking about and get some real answers that we can share with the global community.
Thanks so much, Jonathan, for those answers. So I'm afraid we've exhausted the time available for our session today. And I should say Jonathan's in Sydney, and I know it's getting pretty late there, so we better let you go for the evening. But any colleagues who had questions that we weren't able to answer tonight, we'll follow up with Jonathan afterwards and make sure we can get answers to those for you. Now, in terms of next steps, I know that there's a report coming from the research that Jonathan has been working on, which of course we'll share with the group. And of course, we also had quite a clear proposal there from Jonathan as to how this topic could be taken forwards in partnership with the GSP Working Group. So that is something certainly that with the leadership team of the working group we'll be discussing in our management sessions over the next weeks as we develop a working plan. But I think this discussion today, it's really drilled home how the topic is important, not only from financial stability perspective, but also really from a socioeconomic perspective as well, when we think of the customers whose funds will be at risk without adequately addressing the policy and regulatory gaps that are there. So with that, I'd like to thank Jonathan once again for your presentation tonight, and we look forward to continuing to work with you on this topic. I'd like to thank the colleagues from Bank of Ghana again for their opening address, and also to all of our participants wherever in the world you've joined us from. We will be having some more GSP technical webinars over the course of the summer, so keep an eye out in your email where we'll be advertising future sessions. But for now, thanks so much for your participation. Have a wonderful day where you are. Stay safe.